Hello and welcome to this Rivemont MicroCap Fund monthly update for January 2022. My name is Matthew Martin and I'm the portfolio manager of the fund. Before we start, I need to mention that this presentation is for informational purposes only. This is not investment advice or recommendations. Rivemont may hold positions and trade on the companies that we will mention today at any time without prior notice. Now let's start with a snapshot of the fund as of the end of January. The fund had 15 million of assets under management. The monthly return for the month of January was minus 10%, and that's compared to minus 1% for the benchmark, which is the TSX small cap index, and I'll explain why in a minute. And finally, in terms of concentration, we have 38% of the assets invested in the top 5 holdings, and this is pretty consistent over time. We're typically around 40% on that front. So now let's talk a little bit about the returns. So the fund underperformed during the month of January, and I think the main reason is the divergence in sector allocations. And I've been talking about that many times in the past. The benchmark, the TSX small cap index, has a lot of exposure to energy and basic materials, which the fund has virtually no exposure to. So energy performed very well in January, and we think it saved the benchmark a little bit from going down with the rest of the market. Second, there's the macroeconomic environment. I think I won't surprise anybody when I say that interest rates are expected to increase during 2022, and this is perceived to be a negative for the stock market. And it's not always the case, but it's perceived to be the case, and I think that's what created a bit of volatility and a small correction in January. And finally, there's the low trading volume. We invest in microcaps. Those are typically very illiquid stocks. And when there's a bit of uncertainty in the market, some people want to sell quickly. There's not a lot of volume, and it can create some large swings in companies that have very low liquidity. But this can go both ways. Now we're seeing the downside of the low liquidity, but at some point in the future we can also see the upside, which is stock prices increasing very quickly as well when the market will become better. In terms of outlook, what we see for the rest of the year, first of all, I think it's important to mention that typically the small and microcap sectors are leading indicators of what we will see in the broader market. So typically the small caps will be ahead of the cycle. They will enter a correction before large caps, but they will also get out of the correction phase before large caps. When we look at the microcap sector in Canada, we've been in a correction phase, a bear market for many months already, and the market has not been good last year. I think if you've read our quarterly letters, you read about that already. So now we think there's way less downside potential from current prices when compared to large caps, which are just starting to become volatile and starting to enter a correction. And finally, if we return to a bull market, typically small caps will lead the charge and will be the first stocks to rise. So we think we're well positioned for a potential recovery. Secondly, in an environment where interest rates are rising, we want to own companies that are profitable with no debt, because we don't want companies that need to issue more shares when the market is a bit unstable, or that need to refinance debt at higher interest rates. And that's exactly what we own right now in the microcap fund. Most companies we own are profitable. They have cash on the balance sheet. They have no debt. So on that front, we think we're safe and we're well positioned for the macroeconomic environment we'll be in the next few years. Now I want to present the top 3 main positions in the microcap fund, and that's just to give you a bit of an idea what you own in your portfolio. So first of all, the largest position is Microbix Biosystems. I've talked about it in the past. You can watch our top picks video from a few weeks ago if you want to learn more about the company. But basically, the company is growing very quickly. We expect 51% revenue growth for this year, and we estimate that the company is trading at the price earnings ratio of only 10. So if we compare to larger cap stocks, we think there's a big disconnect in terms of valuations, and quite frankly a very large margin of safety on this specific company. Then we have Accru. Accru is a long-term holding for us. The company struggled a little bit during the pandemic because its customer churn increased a bit over long-term averages during the pandemic, but now it has stabilized, and we feel that the company can return to growth in 2022. On top of that, the company has enough resources to execute on one acquisition, and this acquisition could increase revenues by 20 to 30%. So we see good growth potential for Accru this year, and the company is only trading at 2.7 times its annual recurring revenue, which is, again, we think very reasonable if you compare with some larger cap stocks that can trade upwards of 10 times annual recurring revenues. And finally, we have Imaflex. Imaflex is a bit more conservative. It doesn't have the kind of growth profile we typically look for. We think the company can grow its EBITDA 11% this year. But what's very attractive is the valuation. It's trading only at 4.2 times EV to EBITDA. And when we look at peers, publicly traded peers, they typically trade at 7 to 9 times EBITDA in that industry. So just from a multiple re-rating perspective, we think this stock could be a double. And obviously there's a huge margin of safety at current price. So that's the picture of the portfolio, and the goal of this exercise really was just to show you that we own stocks that are growing, that are profitable, that are solid companies, but also that trade at very reasonable valuations. So we feel like there's a good margin of safety in the portfolio and less room for downside compared to 6 to 12 months ago. Now, a few other highlights that I want to mention. We own positions in 4 private companies, and we've owned those positions for quite some time. 2 of them are about to go public. We expect that in the next few weeks. And when they go public, it will allow us to reprice these investments at their fair market value. So we think this is gonna generate some good returns. Then we have a 3rd private company that is starting the process of going public, and we think it could be public by the end of the year. And then the last one is currently reviewing its strategic alternatives. And if there's a transaction that happens with this company, again, it could allow us to reprice the investment at the fair market value, and we expect to generate good returns as well on this one. So a lot of potential on the private side. And finally, I think the main takeaway from this presentation is that we see valuations right now in the microcap market as very attractive. It's been a long time since we've seen such a good opportunity set, and we feel it's a great time to deploy capital to position ourselves for strong long-term returns. So that's it for the monthly update. Thank you very much for listening and for your time. If you like this kind of content, please subscribe to our channel. We will put out monthly updates every month going forward. You can also visit our website, rivemont.ca. You'll find all the information you need on all of our strategies, and you can contact me by email or phone if you have any questions. So thank you very much and have a great day.